Global markets in 2025 have been contending with a complex and evolving macro landscape. The post-COVID recovery has revealed a critical shift where economic growth cycles are no longer synchronized. Divergence is becoming the norm, driven by varying degrees of fiscal and monetary flexibility across economies. This regime is delivering a dispersion in asset class returns, where fixed income is no longer a passive beta play. It demands active management to capture alpha in a more volatile, policy-driven environment. Over the past year, developed markets have enjoyed a near-perfect Goldilocks environment. Growth has remained resilient while inflation has been gradually declining towards central bank targets, allowing for this normalization of short-term interest rates. This backdrop has supported risk assets and created a favorable environment for fixed income alpha. Credit markets were the standout performer, alongside emerging market debt, consistently beating sovereign bonds despite the volatility. Spreads have compressed meaningfully, supported by strong corporate earnings, central bank easing, and moderating inflation. The move from monetary dominance to fiscal dominance is a paradigm shift. Governments are now actively directing capital towards strategic priorities, making fiscal policy the primary driver of macro outcomes. This introduces greater policy-driven volatility and dispersion in returns across asset classes and regions. Our approach emphasizes active risk management and tactical asset allocation. Flexibility is critical, having the ability to rotate across the fixed income universe, dynamically manage duration exposures, our credit exposures, and currency risk, where agility and conviction are now sources of alpha. We have also broadened diversification beyond traditional assets, incorporating high-yielding credit, emerging market local debt, and securitized assets to capture opportunities in a world where fiscal policy shapes growth and inflation trend. In 2026, we see a mix of risks and opportunities shaping this investment landscape. On the risk side, there's a sharp potential for a rise in US yields if inflation surprises or growth overheats. Persistent inflation in services and goods could also limit central banks' ability to ease policy, while geopolitical fragmentation and tariff tensions continue to inject uncertainty. On the opportunity side, we believe this is a golden window for fixed income alpha. Strategically higher yields combined with resilient growth, creating a compelling backdrop. Emerging market debt and securitized assets offer attractive valuations, and credit markets remain supported by strong fundamentals despite tight spreads. Our positioning reflects these dynamics. We are overweight investment-grade credit and residential mortgage-backed securities in Australia. Globally, we're seeing value in emerging market, local debt, and European investment-grade credit. And with inflation underpriced in markets, we hold inflation protection in both Australia and the US. We remain underweight sovereign bonds across most major markets, where too much easing is priced, given the outlook for growth and inflation. We maintain protection in US high yield and investment-grade credit, given stretched valuations, have recently taken some credit risk off the table, rotating into 7 government bonds to capture yield curve steepness and better relative value. Overall, we're leaning into high quality income and actively hedging against tail risks. Globally, easing cycles are underway, but central banks remain data dependent. Core inflation remains sticky around 3% across most developed markets, and central banks have shown limited commitment to returning inflation to target. Most economies continue to report inflation above target and low unemployment, suggesting inflation and rates markets may be mispricing the risks of persistent price pressures, moving us back to this reflationary environment. We expect the global economy to accelerate in 2026 after a short-term soft patch caused by lingering tariff effects. US growth has re-accelerated with momentum clearly stronger. The potential for upside surprise remains high and US recession risk very low. The US Fed should not be cutting rates with elevated inflation and growth above potential. Our modelling suggests the US Fed should be on hold at a 4% cash rate with no further easing. In Australia, the easing cycle appears to have run its course. Inflation remains elevated, particularly in services, and the labour market continues to show strength. Weak productivity and rising unit labour costs suggest that a modestly restrictive policy stance is appropriate. We do not expect any rate cuts in 2025 and see the RBA maintaining a cautious approach in 2026, keeping cash rates higher for longer. A stagflation shock where growth stalls and inflation remains elevated. This would severely challenge both rates and credit markets and undermine traditional defensive strategies like the 60-40 portfolio. Other potential black swans include a major fiscal crisis in a developed economy or an escalation in a geopolitical fragmentation that really disrupts global supply chains and trade flows. These scenarios would force a rethink of portfolio construction, liquidity management, and hedging strategies. The traditional role of bonds as a defensive asset class is evolving. The historical negative correlation between bonds and equities has become less reliable, particularly during inflationary shocks when correlations can turn more positive. While bonds may still provide that downside protection in slowdowns or recessions, they are now justifying their place in portfolios through income generation and total return potential, especially in these reflationary environments. The structural increase in fixed income volatility further underscores the need for dynamic management. The setup for fixed income in 2026 is constructive, but agility, conviction, and a sharp macro lens will be essential to navigate the divergence ahead.